Craig, what's up, buddy?
What's going on, Brad? Happy New Year, all. Happy New Year, Brad.
Happy New Year, brother. Happy New Year, everybody. Just definitely, we both have had COVID, Craig, coming into the new year. So,
What a way to celebrate.
yeah, luckily, neither one of us were really sick, though. Hopefully, there's not too many other people out there experiencing that. But definitely, I don't know, man. I worked on New Year's Eve, New Year's Day, and on Sunday. So I worked the entire New Year holiday. So I hope that doesn't set the tone for the next 12 months. I definitely don't want to be working every weekend. So, today we're going to be talking about down payment assistance. I don't know how often you're seeing or hearing this, Craig, but I feel like I see a lot of people posting about it. I've talked to a lot of people, and it looks like a lot of people, as a part of their New Year resolution, or should I say goal, a lot of people want to own a home this year. And I know that there's, in most cases, I mean, obviously employment can hold people back. Income, I don't really think income holds people back as much, because income usually just determines how much you qualify for. And in some cases, you need to make at least a minimum amount to own a house. So in some cases it can hold you back. But I feel like the two things that hold people back the most are credit and assets for down payment or closing costs. And today, I think we're going to talk about some options, or one particular option to help with down payment and closing costs. If you guys are watching this and your reason is credit, we definitely can help you take a look at your credit and give you some guidance, some ideas, things that you can do to fix your credit. Or we also have credit repair companies that we have relationships with that we can also refer you to. But if down payment, money saved is what is holding you back, then this is going to be a great little webinar or conversation here. You can learn a way that you can get a $10,000 assistance towards your down payment. You do have to be a first-time home buyer, but you do not have to be a veteran. You do not have to be looking in a specific rural area, because we have talked in the past about the VA loan and the USDA loan, how those are great options to help with your down payment, because they do 100% financing. But this is one option where most people are going to qualify for it, as long as your credit's where it needs to be and you're an eligible applicant, meaning you're a first-time home buyer. So, Craig, why don't we dive in? You're the guru when it comes to this stuff, obviously. So, where do you want to start today?
So, just so everybody knows that in general, most states in the country have some type of agency dedicated to help with community development, first-time home buyers, right? New Jersey's mortgage financing agency is called NJHMFA, New Jersey Housing Mortgage Financing Agency. And you can easily get some facts about this online. So even after this video, they have a really helpful website. They've kind of come a long way with their website and how it's easy to navigate, and you can get some additional facts on that website. So that's pretty helpful. But the main goal for New Jersey's financing agency is to help first-time home buyers, and their main product is a government-backed mortgage, which can be FHA, USDA, or VA, but the most common used product is an FHA. It's called Homeward Bound, and they offer $10,000 in assistance if you qualify to help towards down payment and or closing cost. That $10,000 in assistance is called Smart Start. So there's some basic requirements, and you touched on a couple of them. One is that you have to be a first-time home buyer. I feel like a lot of people think that first-time home buyer means the first time you've ever owned a home, right? So it's not exactly that. It's if you've had ownership interest in a property in the last 3 years, then you're considered a first-time home buyer. If you owned a home 10 years ago and it's been since sold, today you're a first-time home buyer, right? So that's some common misconception with first-time home buyers, is that you're considered, in the eyes of a mortgage, to be a first-time home buyer if you haven't owned a home in the last 3 years. Another important quality of this is, like Brad said earlier, is credit score requirement. You need a minimum of 620. Now, sometimes this changes. The state changes guidelines all the times, depending on what's going on with the industry. I know because of COVID, they had changed this to, I feel like 650 at one point.
Yeah, I feel like a lot of banks, a lot of programs, they took like a risk adverse stance and kind of increased their overlays. And really quick, I didn't mean to cut you off, and I kind of did. Obviously, I'm good at that, but I like to hear myself now. If you're watching this and you're looking in other states like Pennsylvania or Florida or Delaware, we do offer first-time home buyer programs in those states as well. So if you're not necessarily looking in New Jersey, feel free to reach out and we can see if we have options in those states. If not, we have a lot of different friends in the industry that we could refer you to. So I just wanted to mention that before somebody jumps off this call that might not be looking in New Jersey.
Yeah, and you don't have to currently live in New Jersey. You have to be buying in New Jersey, right? That's also a requirement. That's very important to understand. You can't buy in Pennsylvania and take advantage of a New Jersey financing agency program. So getting back to the credit score, 620 minimum credit score is required. They also have different restrictions. And one of the restrictions is that you have to meet median income set by the county. Now, household and this income restriction is based off of household income. So it's not necessarily everybody that's going on the loan. It's all the members of the house that are potentially earning an income, right? So if you have a husband, wife, and a child, that's three-person household. Even though the husband or wife might not be going on the loan, we still need to look at that income to determine whether you meet the median income restriction. And the median income restriction is a certain amount on the low end, and mostly on the low end, you're talking about the more south you go in New Jersey, the income restriction is less, meaning, for example, in Atlantic County, it might be $106,000 for the household, whereas in North Jersey, a 1 to 2 family household, let's just say Hoboken, could be $121,000. So the more north you go in New Jersey, the higher the threshold for the median income restriction. So on the low end for the entire state, it's $106,000. On the high end, it's about $122,000, $121,900. 3+ family is a little bit higher. Low end is $121,900. The high end is $141,680. So that's good information to know. And again, this is stuff that you could check online pretty easily or refer to us. We have access to, look up these guidelines and see if those restrictions change. Another requirement is that you're limited to purchase price amount. So, and these are, based on single family homes up to 2 to 4 unit properties. So that's another good thing to mention, is that we had a previous video talking about maybe buying your first home as a multifamily property. They also give assistance for multifamily properties. So, but as single family home, your purchase price limits are less, right? Being in South Jersey, your purchase price might be less. Your limit might be less. North Jersey, a little bit higher. But as you go up in units, 2 unit, it's higher than a 1 unit, 3 units higher than a 2 unit, and so on. So, and we have those amounts listed on a sheet, and we don't have to go in detail about them. But the more south you go, in general, your income restrictions are a little bit lower, and the purchase price amounts are a little bit lower. And the higher the units, meaning buying more, more unit multifamily property. If it's 3 units, 4 units, a 4 unit is going to allow you to purchase a higher priced house. I don't know if you want to touch base or comment on anything about that, Brad, and then.
No, we have some comments coming in. Carlos, Scotty, thanks guys. Vicky, if you're still on, I did mention, and you might have missed it. This program specifically is for New Jersey, but we do have programs available to people purchasing in Pennsylvania. So I can have somebody reach out, and or I could reach out myself and kind of answer any questions you have. That's
and we also have the ability to do more videos too. So I feel like that'll probably be a video down the line that we'll put together for Pennsylvania residents.
Well, it's funny because coincidentally speaking, Greg, our loan coordinator, is actually in a PHFA training as we speak. I think he's doing it today, or he did it yesterday maybe, but
I think he did it yesterday. Yeah.
We did it a few weeks ago because I guess they require us to keep up to date with new programs and features. So yeah, and actually some of the guys commenting are lenders in other states. So like I said, we do have partnerships all over the place, friends in the industry. So don't let money saved hold you guys back.
So to kind of tag along to what we were talking about with purchase price limits and median income restriction, there are certain areas that allow for higher income restrictions than the normal set forth guidelines or higher purchase limits. They're called target areas. And the state of New Jersey has a software where if you punch in a property address, you can determine whether it's listed in a target area. And maybe you make a little bit more than what the regular standard guidelines are in income for your household, but you're purchasing in a target area or you're looking in a target area. You might meet the target area increased income restrictions or purchase limits. So, and that's something that we can look at. So there's a little exception to the rule, so to speak. All the loan limits apply to the regular standard government programs. FHA loan limits apply. So even though the purchase price range might be this amount, if you're buying a single family home anywhere in the country, right, you're going to be limited to a certain loan amount or a county, so to speak, for FHA. So whatever FHA says your loan limit is, that's as much as you can borrow. And then additionally, the state has purchase price restrictions. VA, I feel like not too long ago, they lifted their loan limit restrictions. So another thing that you want to know about this program is that you can't have 20% in assets left over in available funds after you spend money for down payment and settlement costs. So and this is to ensure that the state of New Jersey is not putting together funds or down payment assistance for people that don't require the assistance, right? That was weird, Brad. I don't know what happened.
I checked out. I was going to share the while you're on it, I was going to share the actual New Jersey housing limits because I had it up, and then I went to close a window and I completely shut this window. I checked out.
I lost my train of thought a little bit. Yeah. So getting back to what we're talking about is, so the state of New Jersey just wants to make sure that you don't have the ability to put down a large down payment and have the ability to get other types of financing like a conventional loan. So if you have enough for 20% down, and believe me, honestly, in that situation, if you have 20% to put down, there might be a better loan for you than an FHA loan with the NJHMFA financing. But that's one of their restrictions, is that you can't have enough for a 20% down payment after you spend money for settlement, whatever's owed between down payment and settlement costs. You also have to have 2 months of reserves, which is important, right? Because the idea here is that you want to use this loan so that you reduce the amount of money that you spend at settlement, not have to show more money, right? But that, in fact, they require that you have these reserve funds, which are emergency funds left in assets after you come to settlement with whatever you need, right? So an example of what a reserve fund is in the 2 months of reserves is equal to 2 months of the subject property mortgage payment. If your total mortgage payment with property taxes, homeowners insurance, principal and interest is $1,000, then you need $2,000 left over after the money needed for settlement, right? So if you owed $5,000 at settlement after you got the $10,000 in assistance, then you need $2,000 additionally saved up. That's a total of $7,000 needed. So just keep that in the back of your mind. Is, a lot of times people think, well, this $10,000 is going to cover everything. You still need to be able to show additional funds as a requirement for getting that $10,000 in assistance. And one other important factor is that the state of New Jersey requires that you get homeownership counseling. It can be a HUD approved counseling service. And we have, as a requirement to disclose on any loan, we have a list of counseling agencies available in the state and to the area that you're buying or area that you're local to. But that's a requirement. I'm not exactly sure how many hours it is now. I feel like it's a couple hours. Sometimes you can do it online. I don't know if they still allow that. They might allow it. Sometimes it require you to do it in person. But with COVID, I feel like everything has been kind of online or phone conversation. But I haven't had anybody say that they don't want to do the loan because of the counseling. And all the counseling is kind of preparing you and giving you advice on what to expect when owning a home, the responsibilities, what happens if you get in trouble with making a mortgage payment, what are some of your options at that point. So it's good information to know regardless being a homeowner. I don't know if you want to add some things to what we talked about for just, these are just some of the basic requirements, not all of the details of qualifying for that loan.
Yeah, no, I mean, I don't, there's really nothing to add. I think you pretty much hit it all. I did want to mention, in case I missed you saying it, because I'm not sure how much I missed when I checked out there, the reserves too, it's just money that can be liquidated. So it doesn't necessarily just have to be a checking account. We can use like 401k assets or retirement assets. As long as they can be easily liquidated, then we can use that as qualifying reserves. And like Craig said, it's just equal to 2 months reserves. So 2 months of whatever the mortgage payment is. And it's not a cost. Like, you don't have to liquidate it. You're not bringing it to settlement. We just want to make sure, because we are exposing ourselves as a lender by giving this money, by funding these loans when there's no skin in the game. So when we've had borrowers in the past where they're getting closing cost assistance, which you might not have mentioned, that you can get a closing cost assistance from the seller in addition to this to almost bring nothing to settle. So what we found is that to, I guess, mitigate the risk in a way is to show that borrowers have the ability to make a few months payment. So that's why we're asking for the reserves. I just wanted to mention that.
And that's the case with any loan that requires reserves, right? It's emergency money in case there's a situation where you need to fall back on those funds. And not for nothing, right? If you're buying a house and you're leaving $0 available, what happens if a appliance goes in your house and you just bought it and you need to make your mortgage payment? What happens if this happens or that? So having those emergency funds as a requirement for the loan is only helpful for you as a borrower for money, because it's truly serving the purpose of what the lender intends it to.
A lot of people too, I find that a lot of first-time home buyers, nothing wrong with this. A lot of people don't have a lot of money saved because you're making normal payments for your traditional expenses, car payments, gas, food, groceries, and you're paying rent. So it's sometimes it's hard for people to have the money saved for a down payment. I think this is a great option, but just something to consider when you close on a mortgage. In most cases, you're skipping a month's payment. So you can almost time this perfectly, where you're buying a house and leaving the house that you're renting, and maybe skipping a payment or not. Like, I think that's the fear, is like, if I'm renting something, then am I going to owe 2 payments? Like, am I going to have to pay my lease payment, my last lease payment next month, and a mortgage payment? So in some cases that's no. And I think make it easy. Like, a lot of people want to rent a house, or they want to end a lease and move right into a property. But that can be overwhelming in some cases, like with the moving all this stuff. So if you can time it perfectly, where you say you close you closed on the house in December, and then you had 30 days in January on your lease, then you have a whole 30 days to move out, maybe paint some rooms in the new house to get ready. You have that 30 days to move out, and then your next mortgage payment or first mortgage payment isn't due until February 1st. So if you time it right, you're not going to double up on payments, and you have breathing room with the move. So I don't know if you're going to talk about that, Craig. I just figured I'd mention
it. Good to add. That's why I'm having you chime in. So to get to the main reason for the talking about this program, what everybody's probably mostly interested in is what type of assistance are they offering? So they're offering $10,000 to help towards closing costs or down payment, right? Or a combination of both. In most cases, it's down payment because it's the larger amount. For most people, they're using FHA financing, right? Because FHA allows for lower credit. Although the state allows for 620 credit score, FHA itself allows for lower credit score than what the state has, which is the 620 credit score. But that $10,000 can be used towards the down payment itself on its own, or a combination of both, down payment and settlement fees, or just settlement fees if you wanted to pay the down payment. So it's used towards funds needed for settlement. So to give you an example, because I feel like you'll better understand this if there's some numbers associated with it. Let's just say you're buying a house for $100,000. FHA has a minimum down payment requirement of 3.5%. That's $3,500, right? Let's just say your settlement costs are $6,500. So that gives you a total amount due at settlement of $10,000. If the state is offering you $10,000 in assistance, that would mean that you owe $0 at settlement, right? So you're not only using a portion of the $10,000 to cover the minimum required investment for FHA, but you're also covering the $6,500 in settlement cost. That would be a perfect scenario if you're buying a house for $100,000 where you're walking to closing with $0 out of pocket. Now, does it always work out that way? No, right? Because you could be buying a $200,000 house where the down payment is higher, and your settlement fees can be, sometimes higher than the down payment. But in essence, that's going to contribute towards your total funds to close. And instead of needing settlement fees of let's just say they're 3 to 4% of whatever the purchase price is, plus an additional 3.5% of the purchase price in down payment, this helps out tremendously for people that, that are looking for a way to kind of minimize what you need to purchase a home. I don't know if you want to comment on anything that we're talking about right there, and then I will talk about, how this $10,000 kind of works.
I think you hit everything. I mean, unless you want me to interrupt you again for another 3 minutes. No, I appreciate that, but no, I think you pretty much hit everything spot on.
So essentially, what are some of the caveats to taking out this $10,000, right? What's the catch, right? That's what people want to know. Okay, I'm getting $10,000. What does that mean to me? So this $10,000 is treated as a second mortgage. It's, to not be complicated, you have a first mortgage, which is your standard FHA loan, right? That's the 96.5%. And this $10,000 is a second mortgage. The good thing about this second mortgage, it has no payment requirement, right? So you don't have to pay principal and interest. You don't have to pay principal. There's no payment associated, but it's money that's owed, right? So I just want to be clear on that. It's not a traditional grant. A lot of people say the housing grant. It's not a traditional grant. It is money that's attached to the title of a property. It's considered a second loan, but there's no payment associated with it. So it is, however, forgivable, right, after 5 years. So if you stay in the loan and you own that home, you don't refinance or sell your house, after 5 years, that's forgiven. That second lien is removed from the property. You don't owe the state back anything. So that's important to know, because some of the downsides to this program, and a lot of people don't want to talk about what's the negatives, what's the positives, but one of the negatives to this loan is that sometimes you're in a position where you want to refinance, right? Whether it's to take cash out, consolidate some debt. In the last 2 years, rates have been significantly lower, right, than where maybe we've helped people in the past with higher interest rates through this state program. You're unable to refinance your house unless you pay off that $10,000. You're unable to get a lower interest rate unless you pay off that $10,000. So that's just important to know, right? If you wanted to take cash out and consolidate debt, you can't do that in the first 5 years. So sometimes if you don't necessarily need to do this program or you qualify for something else, it's also good to look at different options and not just say, hey, I want the $10,000.
Well, that's why we do a total cost analysis on every review. So we're going to show you guys, if you go through our company, our process, we're going to, when Craig does his pre-approval consultation, he provides you with a total cost analysis, which is going to compare this program to some other options that might be available to you, so that you can not only see what the out-of-pocket difference, but also a monthly difference in a 5-year and a 15-year term, long-term analysis. That way you're making the best decision, because rates are important and programs are important, but ultimately I think the most important thing is financial freedom. So it's our job and our commitment to you to set you guys up with a loan that's going to help you achieve your financial freedom point the fastest. So just so you guys know that, you're going to know what makes the most sense when we do that review with you guys.
I think there's pros and cons to every scenario, but the good thing is that we're going to find out what works best for you, right? And give you suggestions based on what works best for you. So another thing that you want to know about the $10,000, that doing a loan through the state of New Jersey, is that there's something called tax recapture. And tax recapture is basically you're paying income tax, federal income tax, sort of like if you took out your money from your 401k early, you're going to pay additional, you're going to be taxed on additional income. So they treat it as income tax. You can pay up to 6.25% of what your original principal balance was when you first borrowed the money, for up to 9 years. So
that's the total loan amount, right?
Correct. So if you're talking about starting from year 1 to year 9, and this is only for the sale of the house. So if you sell your house and you make some type of gain on your property, you're subject to that recapture tax of up to 6.25%. It's a graduated schedule, not to get detailed in numbers, and we can go over that at a later point if anybody has questions about that. But it starts off lower, right, and then ends up, and I feel like in the 5th year it ends up to be 6.25%, and then as you get closer to 9, the 9th year it's back down again. So it goes up, it goes down in a sense. So the longer you own the property, past the 5th year, the less you're going to pay in tax. And then your first year, if you sell the property, the reason is because you're not going to make as much money on your property, as much gain on your property in your first couple of years. So that's just something important to know. Some additional facts about this program, or additional overlays, I would call them rules or guidelines that the state applies over and above what FHA requires, right? Because this, and I say FHA because it's the most common loan used with the state financing. So when you're making an offer on a house, you want to be aware that there's certain things that that you want to do to put yourself in a position to be in, to be able to make a good offer on a property and have it get accepted, right? Right now we're in a market where the sellers are getting multiple offers on properties. You need to understand that this loan usually takes a little bit longer to do, right? So it doesn't take the normal set time frame to to finalize a transaction from start to finish, right? So if you're talking about a standard FHA loan, it might take you 30 days. It might take you 45 days to close on a loan from start to finish. But because there's an additional process involved with underwriting the loan, it could take you longer. It could take you up to, 45 to 60 days even. The one thing that we can't control is how quickly the state works on files. We have the ability to talk to our staff, to talk to our corporate office, and and address rushing certain situations or looking at something immediately. We don't have that ability when the state is looking at a file, if they're looking at it. So just keep that in mind, that it's usually a longer process. And when going back to talking about making an offer, sometimes the sellers know that this loan takes a little bit longer, and it might weaken your offer attraction somewhat. But just keep in mind that it's usually a longer process. I don't know if you wanted something to add to that, Brad.
No, I mean, I think that, yeah, it does take a little bit longer, but, we do set like non-negotiable timeframes for all of our employees on every loan. So we are going to do everything we can to get it underwritten. And are we requiring that these loans are cleared now before sending them to the state?
Yeah, the state actually requires that the underwritten. Yeah, there's like an underwritten certification. It used to be. It's actually better that way.
It was like 10 conditions or less, I think they used to require, right? Like,
yeah, and it's different now. It's almost like the loan is completely certified by our underwriting staff that it's been reviewed and there's no other conditions but what the state comes back with. So
yeah,
it makes it for a quicker turnaround time actually at the state level, because if there's things missing on one end and then we also have additional things missing, it can be a mess because you have two different people looking at the file. So in our experience recently, they've been better at it because the loan is cleared on our end first. So
yeah, and I feel
we
like
do everything we can to get that moving along, so that when the state does look at it, I feel like the reason why I'm mentioning that is that we don't have the control that we have if it's in our office without the state being involved. Sometimes they can take a little bit longer to review things. So just keep that in mind, that it could be a longer period of time than a standard regular FHA loan, because you have that additional process. Some other overlays or additional rules that they have is that all non-medical collections have to be paid off prior to settlement. So if you have some collections, even though you might have the score, you might not qualify for the program until you pay those settlement fees, those collections off prior to settlement. And typically the main guideline with FHA is if you have a payment plan, we could show proof of the payment plan, or we can say the cumulative, if it's less than $2,000, you don't have to do anything, right? I feel like it's $2,000. If you had a cumulative amount of collections on your credit report that are more than $2,000, we could take 5% of those balances, count them against you, and you still might qualify for the loan, right? In this case, they won't allow it. You have to pay those collections off, even though FHA says you might not need to. So medical collections, a different story. They allow medical collections, I feel like, of up to $2,000, but you have to either have a payment plan, or they apply that rule with 5% of the remaining balance to be used towards your debt to income ratio, your liability section. Retirement loan payments, like typically FHA or most loan products, they don't count your 401k loan against you. They don't count your retirement loan against you as a liability. The state of New Jersey does. So just keep that in mind, that these things affect you or affect your debt to income ratio, where normally for an FHA loan they wouldn't affect you. Charge-offs, the one good thing that I would say that they follow suit with FHA is charge-offs. Like sometimes you might have had a repossession of a car and it's a large amount. If it's listed on your credit report as a charge-off, they still treat it as FHA stance on a charge-off, which means nothing has to be done. So that's also a good thing. Another thing that that you would want to know is that the debt to income ratio thresholds are a lot less for the state than they are for a standard FHA. And I feel like that's where sometimes we see people saying, hey, I'd rather do or try to do the standard FHA versus the state loan. And because there's such a big difference in what's allowed with maximum debt to income ratio, the state allows up to 46.9% total debt. And just some quick feedback, if you have, if you're talking about how do we figure that out, right? It's your total credit liabilities, minimum payment showing on your credit report, plus your mortgage payment divided by your gross qualifying income monthly. That comes up with a percentage. That percentage can't exceed 46.9%. So with the standard FHA, you can go up to 56.9%. So that's a 10% swing in debt to income ratio. So the house that you might want to buy, right, you might be able to squeeze into it with a standard FHA, being that you have that wiggle room, whereas the state loan, you may not. It reduces kind of your buying power, so to speak, if you're on the edge of qualifying. And one other thing to know is that, and you're probably going to do this for most purchase transactions, I don't see why most people wouldn't, is they require a termite inspection report. VA requires a termite inspection report. Most of the time, I would say if you're buying a house, you're going to want to know if there's termites in it. But we don't require a termite report unless it's specifically required by the loan type. So VA requires regularly a termite report, but also the state of New Jersey, regardless of whatever loan you're doing, requires that. So, and I don't know if you have something to add, and then we can quickly wrap up why this program is good for somebody and when it's not good for somebody, maybe.
Yeah, I mean, I just want to add to the one thing, like just a few things that you touched on. So, I mean, back to the turnaround time to get this loan funded. Keep in mind, guys, like we're going to do everything we can, but it also helps when the client is proactive, because I found, Craig, you can agree, I'm sure, or disagree, that when we have these housing loans that take longer, it's usually because it's like almost like pulling teeth to get documents from people, so like it does help if you guys get us the stuff that we need immediately. And just to kind of point out one thing that's different about the state loan versus your typical FHA or conventional loan, in a lot of cases, tax returns aren't required for like a W-2 wage earner. And when they are required, depending on the type of income you receive, we typically ask for 2 years of federal returns. With the state program, it doesn't matter what type of income you receive, they're going to require 3 years of federal returns and 3 years of state returns. No other program requires state returns. The reason why is because the state, when allowing this type of financing, when approving your application, they want to make sure that you are in fact a first-time home buyer. And that's the best way to indicate, to see that you haven't reported any mortgage interest on your tax returns. The other thing is, I don't know if you're going to go over this or not, Craig. I know you touched on like the income or purchase price limits, but you can also, and correct me if I'm wrong, you can also use the state housing loan to purchase multifamily homes. And this is back to that whole home hacking thing we talked about last week or in previous weeks. If you're renting and you want to find a way to offset your payment, you can use the state down payment assistance to get yourself into the home, but you can also buy a 2, 3, or 4 family home. So that way you can rent out those other units, and the rent received on those units can now offset your payment. So you can almost move into a house with nothing out of pocket. And if you buy the right multifamily home, you can probably end up covering most of or all of your required mortgage payment. So you can almost move in for nothing and also live for almost free. So it's a great way to start your investment portfolio. I mean, this is definitely a starting step. Now back to the tax recapture. I wanted your take on this, Craig. If somebody did buy this house or a house using this housing loan, we know that if they sell the home, they're going to pay a tax recapture. What happens if in 2 years they decide now they want to move into a different house and turn this into a rental property? Is there anything holding them back from doing that?
I don't know what the state. I know HUD says that they want to make sure that you're occupying the house for a minimum of 2 years. I don't know certainly if the state has additional rules. That's something we could check into. But in what I've read on tax recapture, it's only the disposal of the property. So it's something we'll have to check out. I don't want to say things that I don't know. But when I think of disposal, I'm thinking you've made some gain in selling the property, and that's what you're paying tax on. In my opinion, I would think you're not going to pay recapture on something you don't sell. You know what I mean? You're not getting any gain from or net proceeds from the sale of a house if you're keeping the property. But it's something we would have to look into. It's a good question.
Cool. So, all right, man. Well, you were on your ways to wrapping this up, so let's get it done.
So, just to kind of reiterate, or to kind of go over some bullet points. When is this program good for you? We talked about it. It's lack of assets mostly, right? If you don't have a lot of money, but you can afford to make a mortgage payment and buy a house versus throwing your money away on rent, this is a good loan for you, right? And you're a first-time home buyer. It's always good to look at first-time home buyer options. When is this program maybe not right for you or not good for you? Maybe you have great credit. You qualify for a different loan type, a VA, a conventional loan. Sometimes those types of loans are better than this loan because of the first mortgage component, because it's required that this is, in most cases, an FHA loan, right? So if you have 750 credit score and you have 10% to put down, why would you try to do this loan if you absolutely had money to come to closing with, and you can avoid paying a higher amount of mortgage insurance monthly, have better short-term and long-term effects with that type of loan? So doing a conventional, if you're able to do a conventional loan, we would certainly look at both options, but sometimes having great credit and doing a conventional loan would be better for you in that instance. If you have the down payment and assets needed, if you have 20% or more to put down, there's no reason for you to look at this loan. You wouldn't qualify anyway. If you plan on leaving the house in a shorter window of time, right? There's no reason for you to take on a $10,000 debt if you're going to end up paying it back in 2 years, right? That doesn't make sense to me. This is just some basic information. I'm sure that if we end up, doing an application with somebody, or they submit an application, we can find out whether this program specifically meets your needs, and we'll give you our, expert advice on what's best for you in that situation. And look, we're willing to help anybody and do what you want to do. We just want to be able to give you some good sound advice so that you're making a good financial decision, short-term and long-term.
Well said, Craig. I really, I'm excited about this. I think it's a great program. We've been offering it, I mean, my entire career. And I'm sure you were doing it before I started with Acre, but just listen, guys, if this is something that interests you, keep in mind that we do have a approach where there's no obligations, there's no expectations from our part. We just want to help as many people as we can, which is part of the reason why we're doing this live stream every week, because we want to share our knowledge with you guys. There's a few ways to reach out to us. Obviously, you can visit our website, you can call our hotline, or you can email my loan team. That's all found in the scroll and in the body of this post, depending on where you're watching it, YouTube, Facebook. It might be below us, it might be above us, but you have some different ways to reach out if you're looking to set up a discovery call, or if you just have generic questions, or would like to us elaborate on some of the points we discussed today. If you'd like to get started to seeing what you qualify for, there's a QR code at the bottom right of this little video here.
Is that what they do? Take their little phone like this, Brad?
Yeah, you take the phone, you hold it over, you open. If you don't know how to use a QR code, which I'm inclined to believe most people do, it's the only way to order food these days. Open your camera, hover over that little square thing in the bottom right with the red arrow pointing to it, and you'll see a link pop up probably in the middle of your phone. Click on that link. It's going to take you to a landing page I created specifically for this live feed every week. And you can either, look at your, get options for buying a home or refinancing a home. Both links are there. Just hit whatever's applicable. And guys, if you're watching this and you can think of a friend or a family member, somebody on social media that you're connected to that might find this presentation helpful, please tag them in this. Also, you know what to do. Like, comment, share, help us out. We're trying to help as many people as we can this year. So what's our goal? 500 closed transactions, Craig, just for me and you?
Yeah.
So help us get there, guys. And it's all about helping people. That's what we're here to do. So definitely, we're both a wealth of knowledge. Feel free to reach out. Craig, I appreciate you, brother, and all the information that you provide. Yo, Jimmy, I love you too, brother. Happy New Year, man.
Happy New Year, everybody. But yeah, we'll see you guys next week. And one other thing to add, if you can think of any topics that you might want to hear about, right? Chime in, say something, and we'll address it and put it on our list of videos that we're going to plan to do throughout the year. So
yeah, that's a great idea, because we're just trying to share topics that we think are important, but there might be some things that we're not discussing that maybe you guys have questions about. So you can definitely comment those questions right in the comment section, depending on where you're watching this, or just send them to my loan team at Acre Mortgage, and we'll definitely take those into consideration for future topics.
Cool.
All right. Thanks for joining us, Craig. I'll probably be talking to you in a few minutes.
Take care, guys.
Hey, guys.